Hey traders, Nick here. Wanted to look at, I just had a conversation via email with somebody who's across the world from us, so they're asleep when we're up and vice versa. They were not complaining, they were sharing some difficulties trading credit spreads in this environment. Well, we're not alone. This is the absolute most difficult time to trade credit spreads because of these moves, 800, 900 point Dow moves in hours. And the direction is just completely binary based on what somebody says. This is headline trading, which makes it difficult. Yes, the VIX is high. Everybody's excited to sell risk into high VIX. I'd rather sell risk into like a VIX of 10. I'll take less money for because when the VIX is high, that's for a reason. Because there's going to be big moves. Because we're expecting headlines. And unfortunately, it's enticing and people sell into it, which is fine, but you have to know when to get out. And this is what this video is about. Part of the discussion was, do you track the odds of success, and when do you close it, when do you close the loss? Do you wait until see what okay, here's like a real life example from just today. This is 1/4/2019, the day Powell spoke and said pretty much, hey, I got your back, don't worry about it. I was an asshole before, excuse my French, now I'm not. So here's the deal. I know I'm going to get flack for saying that. Anyway, I did. So there it is. So this is the IWM, which is the small caps. I shared a trade a few weeks ago, a week ago, I don't know, recently, long through June, longer dated calls. I think I chose June. So I'm naked long small caps because I'll show the bigger chart later, which actually shows that they've been beaten down quite a bit, and they've been down 20% plus. Odds are we're going to turn back because I still think that the economy is great. Today we got a great jobs number, 312,000. I guess 311. I missed it by 1,000. So that's the trade I had on hand. So when things were kind of, I sold a credit call spread that expires today to offset it. The credit call spread is a bearish trade, and I chose 136.5, 137, which is right here. So and it was working well, and it profited. And this morning it was about 4 cents to close, 5 cents to close, which means I would have left about 30% of it on the table. It's profitable, and it's it's a hedge against my longs. So I'm long short. I'm long term, and short, I told you, I'm bearish shorter term, more cautious. So I was considering closing it for 4 or 5 cents. I was like, you know what, I'm going to wait a little bit. The odds were still 90% plus I'm going to win today. I mean, who would have thought that, prices we opened up and prices were here and my risk is up here. Nobody thought it was going to run 3% in one day. That doesn't happen often. But I kept it on my watch list. I was eyeballing it. So the odds started dropping as price started moving up and Powell spoke. So I had, okay, where do I decide to leave? It's not arbitrary, okay, because I look at past history and what happened, right? So in this case, I'm going to see if I can get an arrow. Where is it? Okay. In this case, warning sign right here, obviously, and right here. All right, this is prior failure. They moved above it. Okay, I start to sweat. Warning sign number 2, a little bit higher, which is right here. Okay, so these guys are committed. And then when finally this one happened here, I was like, okay, I need to get out. Let me see what time that is. 6:55. I think within 5 minutes of that, I decided to get out. Let me zoom out a little bit to see if there's another level. Yeah. So as soon as I saw them leaving this level right here, 6:55, I think it was 6:58 when it, okay, so thereabouts is where my thing filled. So I closed it right here at 7 cents. May have been 8. I'll double check in a second. So I left money on the table. I collected like 17 to open. So I made some money. So now the calls I bought out in time are cheaper for me, the entry cost, because I just scalped something against them. That's the way I do it. So I think I have it here. Credit call spread 136.5. I paid 8 cents. At the close, they were fully priced. okay, because the IWM closed through the whole spread and it expires today. Now I decided to close because the last level of failure, they overtook it and they ran. So that was my determining factor. So in this case, I tracked price action and decided I'm going to book it while it's green. I don't want to even sweat about it all day, and I'm okay leaving money on the table. So I may have wasted my money, but doing the right thing is never perfect. In this case, it was. Doing the right thing is never perfect, meaning most often when I do this, I end up leaving money on the table because this doesn't happen, and I end up paying 8 cents to close something that would have gone to zero without me having to close it. But in this case, it saved me. If this was 10, $400 or $500, would have been gone. And in this case, I did the right thing, and it played out. So the point of this video is, I don't just hope. I don't sit and hope things work out. And I don't just close based on emotions. Believe me, I started sweating out here. But I was like, okay, I'll wait because. I didn't say I'll wait because I feel like it's going to turn. I'll wait to see what happens. It broke. I'll wait to see what happens. It broke. I'll wait to see what happens. And this was the last straw. Because after that, it just becomes too fluid. And sure enough, it was exactly what I wanted to do. It was exactly the right thing to do, and I got out. So that is... A, I don't just sit and hope. B, I should have a plan, and my plan was I want to see how it handles these failure levels, and they just busted through it. And technically, it's whenever you break a trend, then you've got momentum, and then the buying begets buying, and short covering, and all kinds of problems happen if you just sit tight and wait. So if they weren't expiring today, that's the second part of this video. If they weren't expiring today, I probably would have let them run. So because I want to see, I'm long. So let me see here. I'll give you an example. Actually, before I do that, I'm going to go back to daily. So now this is the same chart, IWM, only every candle is 1 day. The other one was like 5 minutes or something. So you can see the IWM corrected 27% from top to bottom. 27%. That's a market. That's a basket of 2,000 stocks. Okay, so things are not that bad. We have a few worries, China, blah blah blah, but these guys are not China dependent. Most of them are within the U.S. But anyway, so I'm long naked calls, and I was short like right here. And when do I not close them? Whenever it's a hedge, and whenever I think I still need it. Okay, so if I have a credit call spread here, and I have naked long calls right here, okay, if price goes up, the profit from this is unlimited. For as long as price is going, I make money. The losses from here are capped. They stop right here. So if price does this, I wouldn't even bother closing it because the overall trade is winner. So I could close it. I may decide to close it, but even if I don't, the worst case scenario is great. Still, maybe less great than not having it there. Does that make sense? So when I enter my trades, I have to be smart about it. I don't make this risk way too big for it to offset completely. I just want a little heat off. When prices were like iffy, I just wanted a little extra to offset this bullish risk. This balances my overall portfolio. So on every day, I'm not like suffering completely if it's completely directional. Okay, so the first part is I don't just sit and wait. I have a plan. That was what we went over first. And I showed you how I didn't sit and wait. Otherwise, I would have been blown out from 8 cents to 40 or 45 cents, whatever. So and the second part is, when do I do it? When do I close out? How much heat do I take in my hedge? So, but underlying to all of this is the macro, my thesis. My thesis was going into this week that we were going to see a dip, a bounce, and a new low. We had a dip, we had a bounce, and that one day we had 1100 upside point in the Dow, went higher. And I think that broke this new low need. We dipped again, and here we are rallying again. So next week I'll know more about this. But that's besides the point. The point is the thesis. If my thesis is still the same, I leave my hedge. I still need it. If my thesis changed, like it may have changed next week, I may just take this off and I say, you know what, I'm gonna write it naked calls. We'll see. All right. So Nick signing out. This was a quick, perfect lesson. I'm so glad, David, that you reached out to me, because this is a great conversation. All right. Nick signing out.